So welcome back to the session on monetary policy. Beatriz, Gonzalez, and Daria Finocchiaro will now present their work and thoughts on monetary policy and misallocation. And Beatriz, the floor is yours, and you have 25 minutes for your presentation.
Well, thank you very much to the organizers for introducing this paper into this program, and thank you to all of you for being here in the last session. We really appreciate. So I'm going to present Tale of Two Margins, Monetary Policy and Capital Misallocation, which is joint work with Silvia Albrizio at the IMF and Dmitry Khametshin at the Banco de España. So I'm also affiliated with FEMFI. I forgot to put it because it's very recent, but don't forget. So, well, as you all know, we've been discussing today a lot. Monetary policy is not only a demand-side tool, but we know that it can also affect aggregate productivity. And there are several papers that explain different channels through which this can happen. Changes in R&D investment, changes in the markup distribution, and arguably, monetary policy and productivity are really linked to financial frictions. This is the direct mechanism we would have in mind, and the allocation of capital. So the direction of this effect is ambiguous a priori. So if we think, like what we would think the standard mechanism is that monetary policy easing would relax credit constraints, and this would enable high productivity firms to expand, and this would improve allocative efficiency. However, if you were around during the time of flow for longer, you remember that there were a lot of concerns about what would happen with this easier credit that might allow these low productivity firms to be alive, what they were calling the zombie firms, and hence this would mean that we would be diverting resources and dampening the aggregate productivity. So this paper is relatively simple. The idea is relatively easy, but hopefully the message is powerful and it's policy relevant. So we want to understand whether monetary policy improves or distorts the allocation of capital across firms, and if so, through which channels. So this is going to be a purely empirical paper. We're going to use local projections with the quasi-universe of Spanish firms. And we're going to use the monetary policy shocks are going to be aggregated at the yearly frequency. So what we're going to find, in a nutshell, is that at the aggregate, monetary policy easing is going to decrease misallocation. I'm thinking about misallocation a la C and Clino. I'm going to be more precise in the next slides. And when we're thinking about through which margins, we're going to start thinking about what we call the intensive margin, or what are incumbent firms doing. And we're going to show that following this monetary policy expansion surprise, it is high MRPK firms that are ones that are going to invest more. So they're going to invest relatively more than the average firm, and they are going to also access more frequently the credit markets. They're going to borrow more. So it seems that this monetary policy expansion is actually decreasing these financial frictions. And we're going to show as well that this MRPK variable can be, seems to be a good proxy for financial frictions, because we're going to see that this variable shows a higher investment sensitivity to monetary policy than other standard, variables that are used as proxies of financial friction, such as firm age, leverage, or cash. Then we're going to move to the extensive margin, that is entry and exit of firms. And what we're going to show is that following a monetary policy expansion, there is a modest increase in exit and a decrease in exit rates, but that is quantitatively modest. And importantly, there is no significant change in the composition of entrants and exiters in terms of MRPK. Okay? So this is the paper in a nutshell. So what's new? I'm not going to go through all the papers. This is not an exhaustive literature review anyway, but what we're going to contribute is basically all these papers that are thinking about different ways to proxy financial constraint and getting these different sensitivities of investment to monetary policy shocks. We're going to put forward this MRPK variable as being, like, we think, a good proxy for financial constraints, we're going to see another channel through which monetary policy can affect TFP, and this is through the allocation of capital. And also we're related to all this literature looking at this declining interest rates, how this can decrease productivity. So Carolina has a paper on this. That what we're contributing here, or what is different in our paper, is that we're looking at monetary policy shocks, so not just decreases in interest rates. So what we're looking at is different. And of course, we are related to all these papers looking at entry and exit and how monetary policy impact this margin. And what is new, aside from looking at Spain, is that we're going to look at this MRPK composition of entrants and exiters. So the data we have, the firm level data is from Central de Balances. So this is a firm level data set that is hosted by Banco de España. And we include all sectors but the financial, insurance, mining, and public sectors. And we match this with DIRCE data. So this is firm level data of entry and exit that is done by INE, and this combines different data sources, so tax, administrative, and social security records. Then we have monetary policy shocks. As I was saying before, we borrow University Karadi. They are using this monetary policy shock based on high frequency data and sign restriction, and we do some annual aggregation that resembles the quarterly scheme by Ottonello-Winberry. We do have some I'm not going to have time to show you all the robustness we do. We do have robustness at the quarterly frequency for a subset of firms for which we have data. We don't have data for all these firms at the quarterly level, but we do have for a subset. And we're going to see how this aggregation scheme actually delivers us the same results, no matter whether we look at the quarterly frequency or the aggregate frequency, or the annual frequency. So let's begin with the overall effect. What is the impact of monetary policy easing on the allocation of capital at the sector level? So I don't know if everyone knows the CNP framework. Basically, the idea is that within sector, if firms are maximizing, they should be equalizing MRPK. And if they are not, it is because there are some frictions on the back, some wedges that they have, that makes that there is dispersion in MRPK at the sector level. So if this dispersion is decreasing, this means that there is an improvement in the allocation of capital. So this dispersion in MRPK is lower. So we want to test what happens after an expansion in monetary policy shock, and for this, we're going to do the following local projections where we're regressing the changes in the variance of MRPK at the sector level on the monetary policy shock, and we're having different macro controls and sector level controls, and also sector fixed effect. And what we find is what you can see in the figure is that after one standard deviation monetary policy shock, we see that the variance of MRPK falls over time, reaching this maximum decrease of approximately 1.1% after 3 years. And if we borrow the CNP framework again, a back of the envelope calculation with some assumption on parameters tells us that this monetary policy induced reduction in capital misallocation could raise the FPR by 0.7% after these 3 years. So this is what we see, so to say, at the aggregate level, at the sector level. Now we go to the firm level data. Let's see what happens at the intensive margin. So now we're going to run similar local predictions, but at the firm level, where on the left-hand side, we're going to have the changes in the locked capital stock. We're also going to use the same specification, but with changes in debt later on. But now we're going to focus on investment, on changes in capital. And we have exactly the same controls as in the previous regressions, just that we are adding firm level controls. And what we're interested in is in this impact of monetary policy, this beta 0. This is the interacted variable, which is the monetary policy shock times MRPK. This MRPK is going to be the mean at the sector level. So this is simply the deviation unstandardized. So these are going to be the deviations from the sector mean. So the beta 0 is then going to give us the average response for the average firm in the sector, and then we can understand this beta 1 as the response of a firm that's one standard deviation, that has a one standard deviation higher MRPK. Okay, so this is the beta 0. So what we see, as we would expect, is that for the average firm, after an expansionary monetary policy shock, the firm increases investment. And the peak effect is at year 3. So after one standard deviation monetary policy shock, this increases around 1.7% of their capital stock. But what we're interested in, because of our exercise, is on this differential effect. So a firm that is one standard deviation, that has one standard deviation higher MRPK, they would increase their capital stock but by 0.8 percentage point more after 3 years. And so I know that now it's a mess to click on things, so I'm just going to explain to you what was under this clicking. So this matters because at the aggregate decomposition, so if you see at the aggregate capital stock, actually higher MRPK firms only account for 23% of the overall capital stock. But if we are starting accumulating these increases in capital stock, after 3 years, they account for more than 50% of the increase in aggregate capital. So this differential effect matters for this composition. And then we run like many robustness tests on these findings. So we look at alternative monetary policy shock and alternative ways of adding them up to the yearly level. We have alternative demeaning, standardization, industry year fixed effect, firm fixed effects. We include lag controls. We do this exercise with quarterly data. So where we have a subset of firms that are larger, more manufacturing firms, but for which we can see quarterly level data. And what we do is basically replicate this analysis at the quarterly level, and for this subset, aggregate to the annual level and see whether we get similar results. So to say, just to understand whether the artifact of this having to sum up all the shocks to the yearly level is actually driving this. But we find that similar results just have differential effect that's smaller, but this is because like firms are really like large firms, manufacturing firms, so there is less heterogeneity there. So then we go to thinking about firm borrowing, and this is a little bit small, I'm realizing now, I'm sorry. What I'm showing here in each of the tables, in the first part, you're going to have, this is always the first is the average effect, and the second line and the second bar is the differential effect, and what I'm showing here is the peak effect, so the 3, what happens at year 3, okay? Instead of showing you the full dynamics, I'm just showing you the peak effect just as a summary so that I can show you more things. But what we find is that first, running the same regression with the log debt instead of log capital, we find that the average firm increases their debt, but higher MRPK firms are increasing it more. But it is not only on the intensive margin, because this is restricting us to firms that had the previous year some debt. But this is also the case when we're looking at the probability of having debt. So the second graph is showing us what happens when at the left-hand side we have the probability of having debt. And then we decompose this into the probability of issuing debt if I didn't have debt in the previous year, or the probability of maintaining debt, which is having debt today if I already had debt the other day. So it's some sort of decomposition of this extensive margin. And we always see that there is the average effect is there, and the average effect is relevant, but there is also a differential effect. So high MRPK firms actually can have an increased access to the debt markets and to the amount of debt they can borrow. So what we've seen so far is that after this expansionary monetary policy shock, we have high MRPK firms investing more, and it seems that at least part of this investment is financed by issuing more debt. And this is consistent with the idea that high MRPK firms are financially constrained. But for people that work in the literature, you know that these financial constraint proxies are always like a bit, it's very hard to find like empirically something that's a good proxy for financial frictions. I'm not claiming that this is all the solution, but at least this is pointing to the right direction. So what we're going to do is test how MRPK performs against a standard measure of financial constraints in the literature. So what other papers have used are heterogeneity in age, saying that young firms are actually more responsive to monetary policy shock because they're usually more constrained. Cash, for instance, if I have cash, I might just use the cash I have stored on the bank, and then I do not need to go to the market, so I do not react as much to changes in interest rates. We can think of leverage as well, and here it depends on the, I think there's no consensus, but there are some papers saying that if you have low default risk, you are more responsive. Some others say that if you have high leverage, you might be more responsive, so it's not clear, but it seems that it could also be a good proxy for this responsiveness of monetary policy. So what we're going to do is run exactly the same regression as before, with the sole difference that we're going to separate firms between high MRPK and low MRPK, so just an indicator in two groups, okay? And then we're going to do the same with age, with cash, with leverage, so young versus old, and this is always with respect to the median of the sector the firm is at. Okay, so every firm is going to be in high or low MRPK, young or old, and the same with all the other variables. And we're going to interact them and interact these interactions with monetary policy, and we want to understand whether these different groups have different responses to monetary policy shocks. So what we see, and let me focus on age just for the sake of explaining, but it happens the same in the rest. So if you see, actually, young firms have a higher responsiveness than old firms within their low or high MRPK bucket, but it is really high MRPK firms the ones that are driving this response. So old high MRPK firms actually respond nearly 3 times as much as young low MRPK firms. And this happens with cash, something similar happens with cash, with leverage, with this interest coverage ratio. So it seems that actually these proxies of financial constraints or sensitivity to monetary policy, if you want to call it like that, actually have a lower explanatory power than MRPK. So let me go to the extensive margin now. So remember, like now we've seen at investment, at debt holdings, and now we want to understand entry and exit and the composition of this entry and exit. So the regression we're going to run is very similar to the one we had at the beginning, because this is going to be at the sector level, okay? So this is going to be entry and exit rates at the sector level, where this left-hand side is going to be the normalized entry-exit rate. Why do I say normalized? Because we're going to have the number of entrants or exiters in the numerator, and then in the denominator, we're going to have the number of active firms at t-1, so that we can compare, we have like a fixed point, like a normalized point to compare at different points in time, and also so that we can compute cumulative entry and exit at the sector level. The rest is very similar to what we had in the variance of MRPK regression before. So we have macro controls, output growth, and sector fixed effects. And something that we can do, because remember that we can match this entry and exit with our firm level data, we can know whether a firm is high or low MRPK firm when it entered or exit. So when the firm enters or exit, we look at their MRPK, and then we level them high or low MRPK firm depending on the industry they're at. So we can see this composition of entrants and exiters. Of course, the sum of NH and NL needs to be equal to N, okay? Because the low MRPK and the high MRPK firms, the sum and that are entering, the sum is all the entrants in the sector. So we're going to run this regression for the overall number of entrants and for high and low MRPK, and this is what we find. First, let's focus on the point estimates, so the dots. What we see is that expansion in monetary policy shock is increasing entry rates in the short run, and it is decreasing, although this decrease is not significant, so I wouldn't highlight that, in the third and the fourth period. And the exit rate, we have that there is a decrease in exit rate, and then it goes to 0 with this small overshoot in period 3. And Quantitatively, this is not very large, okay, because we have this is around 0.20 and 0.11, the highest response, and average entry rate is 5.1% and exit rates are 3.1% respectively. But more importantly, we see that there are no significant changes in the composition of entrants and exiters, because the light green stacked bar is the contribution of low MRPK firms to the changes in entry or exit, and the dark green stacked bar is the contribution of high MRPK firms. Okay, so in general, the contribution is relatively similar. We test whether they are different or not. In most of the periods, they are the same, and if they are different, the significance is barely there. So we conclude that there are no significant changes in the composition of entrants and exiters. So let me conclude, and I want to conclude because I want to click there, so please be ready. Using the quasi-universe of Spanish firms, we find that high MRPK firms are going to increase their investment relatively more as opposed to the average MRPK, the average firm, and they are going to borrow more as well. And we see that there is a small positive effect on firm entry and a small negative effect on exit. But importantly, there is no effect on this MRPK composition of entrants and exiters. And well, we provide some evidence that we think that MRPK seems to be capturing some financial constraints that get relaxed after this monetary policy easing. And the overall effect, which is the first time that I showed you, is that actually this monetary policy easing is improving the allocation of resources in the medium run. And now, if you could please click on the, yes, thank you. So this is just to show you that this exercise, we replicated it because Dmitry and I were part of the ECB forecasting working group and the expert group on productivity. And within this group, we did a micro-distributed exercise where we shared our code and we gave it to other European central banks so that they could replicate this analysis with micro-level data that's proprietary in other national central banks. These were the countries that signed up for the exercise. And what we find are that at least qualitatively, what I showed you here actually is there in most of the countries. So the green bars, what you're seeing is the peak decrease in the variance of MRPK after an expansionary monetary policy shock. And the number that you see there in white inside the bar is the year at which this peak effect occurs, because there is heterogeneity according to the country, but we see that in all the countries, we see this decrease in the variance of MRPK at the industry level. And on the right, you see these orange bars. What you see is this differential effect of high MRPK firms. And what you see again is that quantitatively, it's, there is variation, but we see this positive differential effect in all the countries. So if you can go back. So, okay. This is it. Thank you very much.
Thank you, Beatriz. And now Daria will discuss the paper. And Daria, you also have 10 minutes.
Thank you. So thank you for the opportunity of discussing this super interesting paper. And I also want to thank the ECB, CEPR, and BIS for sponsoring this great initiative. Thank you. Beatriz already explained very well the paper, but what's the main question of the paper? It's asking how monetary policy affects capital misallocation. And the paper thinks of capital misallocation according to the definition in the sense of is clean loss, so captured by dispersion in the marginal revenue product of capital. And it goes even deeper because it's not only about documenting how monetary policy affects this person in this MRPK, but also what are the underlying mechanisms, why that's the case. And the core idea is to exploit yet another great data set on quasi-universal Spanish firms to measure within the industry dispersion in MRPK, and then track heterogeneous effects on investment and borrowings of the firms after monetary policy shocks. And what's great is also not only they can look at the intensive margin, but also at the extensive margin. So hence, it's like a tale of two margins. Identification is like using high-frequency monetary policy shocks mapped to the firm year horizon. So what are the main findings of the paper? Does monetary policy affect misallocation? Yes, in a positive sense, because after monetary policy easing shock within industry, MRPK dispersion falls. And why is that the case? Through which channel? The paper argue with extensive battery of tests that it's about the credit channel of monetary policy. First documenting that firms' investment sensitivity to monetary policy shock is higher for firms with high MRPK, and that this is a better proxy for financial frictions. And then also showing that actually this is happening more on the intensive margin rather than the extensive margin. So this is, of course, a great, important question using excellent data set. And it's also nicely complement the theoretical contribution in another paper of Beatriz. That actually Beatriz presented the other paper at the previous edition of this conference. And in the meanwhile, she managed to produce 2 great papers, 2 human beings, and that's like empirical evidence on women productivity and ability of multitasking. So that's, but there is and why is it important? Because there is a very large theoretical literature on the credit channel of monetary policy, and yet there is no consensus on what's actually a good empirical proxy for that, but even like on the effects of how does and I will say that more, on the effects of monetary policy on the credit channel. The paper does lots of robustness tests. The appendix of the paper is 40 pages, so I'm not gonna talk about yet another robustness test to make the appendix even longer. So let's look at what can be done next with this great data set. And to do that, let me go into the main idea of the paper and think about the theoretical mechanism that is behind that, because that's really like my comparative advantage. So in absence of frictions, all firms should have the same return to capital. But then it's possible to show, and this is done in previous literature, that is, if there are policy distortions, and let's call them frictions. I don't want to call them financial frictions because it's much more general than that. There are frictions that can impact on marginal product of capital or marginal product of labor in different ways. There are frictions that can impact on both margin in the same way. And for all these reasons, the marginal revenue product of capital can be different across firms. Why do we care about that? Because that's actually a measure of capital misallocation, and it can be shown that it's like if that's the case, it's like there is a nice formula that linking aggregate TFP to dispersion in this margin. And what Beatriz and the co-authors have shown also in the theoretical paper is that they argue that actually that this friction on TK wedge, like the wedge, is something that can arise if firms face collateral constraints. And actually, even in that paper, there was like a small empirical part documenting that high MRPK firms are more responsive to monetary policy shock. What they do here is test directly A, C and partly C, even talking more about that. So let me give 3 main comments about this. First is we talk about financial friction, but financial friction is like a big umbrella term encompassing different ways in which frictions can have an impact on firms' financing decision. And it turns out that the effects of the financial decision on firms' investment, so first is it's very difficult to measure them in the data. That's something that, but even the effects of financial frictions on firms' investment, it's not something that, because it can go in the opposite way. This is something that it's shown in Ottobelli and Wimberry. Why? Because it's financial friction make marginal cost of firms upward sloping. Through that effect, it reduces their sensitivity to investment to monetary policy shock, but then monetary policies can flatten that curve and that increase their sensitivity. So, and if you look at the characteristic of the firms that have high MRPK in your sample, actually they also the ones that are less levered. So I wonder if that's really squares with the idea that the financial frictions, at least in the background, is a collateral constraint, or if how often is whether there is other financial frictions in the, for example, how common is on Spanish data earnings-based constraint, because that's not really a story about collateral. Even if okay, this is we don't know which exactly financial friction, but there can be even more friction. I'm not saying that financial frictions are not important, but maybe there is the interaction between different friction. That's remember in the original papers, it's about friction in the capital, but also in the output. And it could be that dispersion in this revenue of capital reflects markup heterogeneity. They can reflect also different level of adjustment cost, so more real frictions rather than financial friction. Could be the case also that capital elasticity within industry could also generate the same dispersion. And in general, whatever is under the umbrella of output distortions can create dispersion. So again, it's not about testing for and showing robustness about it, but these are also important channels that you could check in extensions of the paper. And then I was a bit surprised about the results of extensive margin, because I thought that extensive margin in theory could be very important. And then I thought that maybe it's related to the fact that the effects on the extensive margin could be state dependent. So there is a literature showing that, for example, productivity dispersion is greater in recession rather than booms. There is another paper also of economists here, economists here at ACB, showing that asymmetric channel of monetary, the credit channel of monetary policy can be asymmetric, so different if it's an easing or raising rates. So maybe it could be interesting for another paper, not for the appendix of this paper, to check at the state dependency or comparing easing or tightening of monetary policy. So this is a great paper, broadens our understanding of monetary policy transmission using excellent data. There are some open questions and possible extension about which exactly financial frictions or which friction is really relaxed by monetary policy. You could decompose between and think about the decomposition between markup and wedges. And then I'm a big fan of asymmetric effects of monetary policy, so that's also something that could be interesting to do. Thank you.
Thank you, Daria. So, Beatriz, I will let you reply to Daria.
Thank you very much for your discussion. So, yeah, actually I forgot to mention, but this is very related to my theory paper. In that paper, this misallocation comes from financial friction, but this is a very stylized model, because in the end, so actually we took out all the empirics because of the, actually the referees told us to do so. So we're focusing on optimal monetary policy. So now that is really focused. So we have a stylized model that we know that will not match the data exactly because of what you're saying, but we're using this as a laboratory to explore these implications for optimal monetary policy. And so thinking about what are the sources of this misallocation, as you correctly point, financial frictions can cause this misallocation within sector, but also different capital adjustment costs, different capital elasticities. This is one of the reasons also why we're focusing on within sector, because capital elasticities vary a lot across sectors, so we're focusing on within sectors. And what we think, so we're not claiming that all the dispersion we see at the sector level comes from financial frictions. There are 1 trillion things, as you were saying, but what we're seeing when we have this expansion monetary policy shock, something is moving. So we think it is hard to believe that are these structural things that are changing at the short run because of this monetary policy shock, and because of the test we did, we think that what is changing is financial frictions at the short run, with a lot of other frictions operating for sure. This easing versus tightening and asymmetries is super interesting. We did try, but since we have we have to aggregate at the yearly frequency, then if we start separating it's it's hard to learn anything. So hopefully, if we could have better data, maybe we could do this, and this would be super interesting. But so far, it didn't work. And regarding earning-based constraints, actually I have another project where we're looking at the characteristics of debt for Spanish firms with the credit registry data. And actually, I think it was between, I forgot now the exact number, but between 70 and 80% of debt is uncollateralized loans. So there is a lot of earning-based constraints if you want to think about it. So, I mean, for this project, I don't think we're going to exploit, but this is a very good idea, I think, for the future, to understand how these different types of debt can react to monetary policy, also depending on the type of collateral even. So I think this is a very promising avenue, hopefully, for future research. Thank you.
That's great. So, and now we can take a couple of questions. Where there? And then Hélène.
Super interesting paper, since you talked about earnings-based constraints. Victoria Vashna showed, using Spanish data, that these debt with earnings-based constraints, where cash flow-based debt is more sensitive to bank lending shocks and so on for a variety of reasons. And if it's true, then you can think about sectoral heterogeneity, especially as the economy becomes more intangible, intensive. The development of these industries are very important. That's one. The other thing I was curious about, there was work showing there are cyclical variations in misallocation in general, that in booms there are more reallocation than in recessions. So I'm curious how much of what you see is distinct from the general business cycle fluctuation in reallocation, which has implication potentially for policy. Like your first couple of slides gave people, kind of prime people to think that maybe monetary policy decision makers need to think about this as an additional channel of monetary policy transmission. But it could also be that it's part of the normal course of stabilizing the economy, and these are not byproducts, but natural consequences of the normal stabilization of monetary policy.
Thank you. Yeah, super interesting. I'm intrigued by your extensive margin results, where the exit rate decreases for both high MPK and low MPK firms. That's correct, yeah? Mm-hmm. So is it due so low MPK could be explained, relatively simply. The high MPK, is it a crowding out effect? I mean, can you investigate that? Is it maybe within sectors or something like that? That would be interesting. And then Daria pointing out there's also this maturity debt effect potentially. I wonder if your high MPK firms, if they are kind of, I don't know, I don't know, venture capitalist firms or innovative firms in some sense. There could be also a correlation between the short-term debt for some lack of trust by some types of investors, maybe the banks, or I don't know if you could explore a little bit more of the link between maturity and your high MPK.
And Jan, last question from Jan.
Thank you. Very interesting paper. So I'm wondering whether you can also check like other inputs, like margin product labor or the intermediate inputs. What happened? Thank you.
So if there are no other questions, I also, going back to Helene's point, if you could share some more insights with us about what type of firms are these high PRK firms?
Okay. Well, can I? Okay,
yeah,
thank you. So I'll try to go in order. So thank you very much, Joran, for your comment. Yeah, this Ivashina paper actually uses this credit registry data, so it's very similar. If I remember correctly, I think they were looking not as a monetary policy shock, but it was interest rate changes. But definitely, we could think about this sectoral heterogeneity, this intangibility, at least at the sector level. We try to. We're actually not looking at intangibles here because at the firm level data, since also we have like the universe of firms, it's self-reported data, it's a bit, but this is actually something that's very interesting that we could check at the sector level. Regarding this cyclical variation in misallocation, it's right. So to the extent we can, we try to control for it, introducing year fixed effects. We have this robustness having industry year fixed effects. So hopefully part of this cyclical variation is captured by that, but arguably not everything, that's true. So at least if you have any idea of any other way we could control for that, it would be great. Helene, regarding the exit rates, so why is it that high MRPK firms are exiting as well? That's a good question, and that I would like to know. So actually, so if you think about low MRPK firms, you think like these low productivity firms, the threshold moving. So this is the standard story we would have in mind. But then why are these high MRPK firms exiting as well? So we haven't. So I don't have a good idea of how to explore this. If you do, please tell me. It could be because of. I don't know, because maybe like there's also heterogeneity in how much leverage they have or not. I don't know. So this is something very interesting, but which I'm not sure how to tackle, honestly. Regarding differences in the maturity of debt or other heterogeneity, with this credit registry data, we can actually have a look at this, and this would be something super interesting. Also, like thinking of Ottonello Winberry and these papers that look at this, and there's also this paper by Junger et al. That they're looking at this, the paper that you were. So yeah, this is super interesting, and with this data, we could have a look at it. Regarding venture capital innovative firms, there might be some, but I don't think there are that many in this data set. Because this is like the universe of Spanish firms. There are some innovative, but honestly not that many, unfortunately, and not that much VC either. So even though there might be something, I don't think there's much there. Though, I mean, if we had like alternative data sets like PitchBook or other data like that, where you can see venture capital money, and you can link it to the firms that are having this, which are not many, but then maybe you could see this. And regarding the heterogeneity with MRPL and intermediates, this is actually something interesting. So we do look at TFPR, so the overall measure, not at MRPL, but this is something we could look at and it would be interesting to see. And regarding these high MRPK firms, so we do have like this summary statistics. So these are actually, there's not that much differences in age. So they are relatively similar in age, but they have, like high MRPK firms have low leverage, as she was saying, have higher cash. So it seems that they look like high intangible firms a little bit when you see like the summary statistics, but yeah. So thank you.
All right, so we are perfectly on time. Thank you very much.